Testing. Testing. There we go. Okay, how are we now? Audio check, audio check. Give me a thumbs up in the chat. Yes, yes, yes. Uh-huh, uh-huh. All right, yeah, that's weird. So, let me check a couple things. All right, so let me do this. Give me like 2 minutes, and I'm going to go back in and start the whole thing over with risk disclaimer and whatnot. I want to make sure that's on there officially. For some reason, the typical setup with the microphone did not pop up. So I just want to give me 2 minutes, okay? Just stand by. Thanks for your patience. Give me a second. Okay, so this should work. I was just going through the social media page. You know the deal. Mondays and Fridays, youtube.com/Chris Pulver. Best way to find me. Join the channel, subscribe, get the notifications, take a look at the Keep It Seriously Simple video series. Make sure you're following the real me. All my handles are the same. Real Chris Pulver on Facebook, Instagram, Twitter, and TikTok. Not the Chris Pulver, not official Chris Pulver, not underscores, not numbers, no messages from me, no solicitations from me. So if that happens, report that fishy activity. But best place to find me here Mondays and Fridays, and sometimes bonus sessions like non-farm or FOMC days and other stuff. But check out everything on the channel, youtube.com/Pulver. All right, one more thing. Stand by. Testing. Okay, let's go back to the risk disclaimer. We understand there's risk in trading. Please and always use trade capital only. Do not trade with money you cannot afford to lose, whether trading stocks, options, futures, forex, cryptos, you know the risks. Sorry we had to rewind it, but for some reason my standard setup here wasn't working, so I just had to add the extra microphone. So we're back to the trading page now, and microphone is good, audio is good. Thank you very much. What I was talking about, and again, I appreciate everyone jumping in and saying, we can't hear you. If you joined myself and Dave Floyd and Jared Johnson last night, we were in the trading battle sponsored by 8cap, and we had a great session. If you didn't have a chance to check it out live, I would encourage you to check out the video trading battles channel on YouTube. You can see it on Instagram as well. But 8cap does a fantastic job. Their team is awesome to work with every single time we do this. I've been a panelist like I was last night. I've been a host as well. But I was forced to take a loss because my trade size was 10 standard lots on a $10,000 account. Fortunately, 8cap is a non-US broker, so I had better leverage, but I did take about $110 loss on that trade, and then I had about $1,500 in profits this morning. So I went ahead and took those profits and protected. And so my balance started at 10K. I'm up to 11,384, and I'm going to keep that in the green for charity. So I know possibly Dave Floyd's trade is still running. So we'll see how those work out going into today's trading or going into next week. I think we can hold these all the way until next Wednesday, but I'm gonna go ahead and take the profit and make sure that I'm donating to the cause. So good stuff. All right, that way that's one less thing to worry about. We have some stocks to review today. I'll close this down. I may actually have a decent week. So forex wise, let me check out a couple of things. Let's see how the robots did this week. So my perfect storm up 323 pips this week. Pretty happy with that right there. So nice little full auto trading, 323 pips. I'll take that any single week I can get it. So thank you, Perfect Storm. You rock. And Pockets Pattern Pro, same thing here. How'd this one do this week? 298 pips. I'll take it. So both full auto. This is what I do. I check them on Fridays. VPS is running. It's one instance on the VPS. Robots are running uninterrupted. The Pockets Pattern Pro robot is trading 21 currency pairs, and the Perfect Storm is trading 10, I believe, like 9 or 10. So, again, full auto. I love the logic. It's built for consistent profits. It's built for managing its way through trades. and it continues to do that pretty well. Collectively, I talked about this yesterday in my flex room. Between our flex page and these robots, this is up around 5,500 pips for the year, and the other one is up around 6,000 pips for the year. So 5,500 plus 6,200, so that's 11,700 pips. And you take 11.7 and add it to our little chunk here, which I believe is over 15K. We're at 15,061. So far for the year, and again, thanks to automation, this is certainly helping, but 15,061 plus 11,700, up about 26,760 pips this year. I'll take it. Now, does automation help that? Yes. Are we going to have some big chunks of profit rolling in on something like Euro dollar, Swiss yen, and Euro Swiss? Yes. I would anticipate, getting probably another 5,000+ pips out of those trades, maybe more. Depends on the number of entries and how they end up, totaling or where I take profit at eventually. But, we're doing our best to grind out some profits this year. Okay. So let's take a look at the currency strength chart. We'll kick things off with dollar index, oil, gold, and silver. Look at crypto. So far this morning, vertical axis is pretty contained. I wanted to share a screenshot. If you weren't in the live sessions with me this week, let me go to this one here. Take a look at the screenshot. This is the story of CPI on Wednesday. 8:07 a.m. right before the news, like, oh, look at that. The Swiss is stronger. The New Zealand dollar is stronger, but the vertical axis is pretty contained with a 40 and 35 top and bottom. And then at 8:42, scroll down, this is 12 minutes after the CPI news. We just had this massive jump. It was a weaker dollar, weaker CAD, and a big jump in the yen, a big jump in the Aussie, New Zealand. So you can see that the vertical axis is stretching. The dollar just got smashed. 924 just before the Wall Street Open. Futures was skyrocketing up. Everything was up 1.5, 1.6% pre-market. And it held on to those levels because even throughout the morning, you can see that by 10:06, the dollar made a explosive news low and then proceeded to go lower. The JPY made a high and proceeded to go higher. So we had a really nice move in Forex. I mean, we've had some pullbacks. We're not at fresh lows right now in the dollar yen, but we have done some pretty good work on confirmation. And then later in the day, I took a screenshot at 3:02, and this is how the day was kind of shaping up and wrapping up as of 3 o'clock, and then 5 o'clock, it pretty much looked the same. But what a story, right? Just watching intraday trading, tons of volatility on Wednesday, and here we are with the markets up. Okay, now a little concern this week would be where we are at going into today's pre-market. So 18 minutes for the open, pre-market at 422. A little bit of an overbought condition. I don't want to go to the daily chart because we're up to these 200 EMAs. So this is going to be a really interesting level. The S&P, or this is a SPY right here representing the S&P 500. We're up above this 200 moving average. Now we could have a little bit of a pullback. Let me get this drawing tool back up and running. We could have a little bit of a pullback going into next week. We have some big monthly expirations. But for the most part, I mean, we've had a fantastic recovery. Saw an interesting article last night on Bloomberg, or from Bloomberg, from Bloomberg, and the article was titled, "Have Stocks Bottomed? Not Until This Gorilla in Equities Market Budges." That's a Bank of America warning. Basically, the warning is U.S. stocks in household ownership. So your common retail trader, they haven't been selling. So if you would have, with the kind of, projected pessimism, you didn't really see households selling. And that correlation has happened back in 2020. We had a big COVID crash. It happened back in 2008, and it happened back in 2001 after the kind of tech deleveraging. So here are my thoughts on that article. I mean, a good article, makes an interesting point, but part of me thinks that, retail traders at this point, household stockholders at this point, you're putting household wealth in one of the highest levels we've ever seen, thanks to stimulus and thanks to household equity. Real estate has had those levels where everyone's house is worth a lot more. I know that the reality of the real estate world right now is people are chipping down on their sales prices. If they're trying to sell their house, they're trying to discount just a little bit. Rates have fallen from 6+%. The 30-year fixed mortgage rates got up to 6+% from sub 3 but they have since fallen into the fives, even sub five, as early as this last week. We've fallen into the sub five. So let me check Mortgage News Daily. And you can see here the 30-year right now, it's up a little bit. We're at 5.27, but we have seen certain lenders dip below 5%. So there will still be possibly some refinancing out there. Let's say if you closed on a house at 6.25, okay, if you can refi right now at 5.25, is that worth it? Or are you going to see if it goes down a little bit lower? I don't know. I mean, that's the thing is I think we're playing a pretty dangerous game. Would I love to see mortgage rates go lower? Of course, obviously. I mean, if anybody's in the market for refinancing, you want to see rates go down back to 3%, 3.5%. But will they? I don't know, because the Fed is probably going to continue to tighten. Okay, and so even though the market got all excited this week on the CPI data, it was 1 month. And CPI data alone is not going to drive everything about this, recovery in this peak inflation. So what we did see change, and I took a screenshot of this also and posted it in Flex this week, right here. So there's the screenshot we just went through with all the timestamps from Wednesday, and then I wanted to post this screenshot as well. As of August 9th, the probability was for September's rate hike that the Fed was going to raise 75 basis points and get the official cash rate up to 3%. With the inflation data on Wednesday, this completely flopped. So August 10th, now you can see that the probability is the market's expecting a 50 basis points hike to scale the rate back down to 2.75. So we've talked about this. We should know this. Right now, the market is anticipating a 3.25. Okay, 3.25 to 3.5% cash rate for the Fed by the end of the year. As long as that threshold is not broken, okay, this is what I think is happening. And again, my thinking versus what I see in the charts, obviously I'm trying to follow the technicals and I'm trying to follow the charts. I am cautiously bullish at this stage. I think if we're going to continue to see a rally, it's probably because of a bit of a FOMO trade. It's because you've got big money on the sidelines that's looking to get back in. I'm more interested in buying dips right now than I am selling rallies. I think that this bear market talk and this projected pessimism is taking a back seat. I know that we have geopolitical risks. I know we have probably a crazy midterm election coming in November. I don't know if the market really cares about it. I think the market cares about what the Fed is going to do and where the Fed will be. And if the market is successfully priced in this rate for this year, I think that gives the market a chance to weaken the dollar. And in weakening the dollar, the correlation is a stronger equities rally and a stronger risk-on rally. So in equities rally, S&P 500, Dow Jones, NASDAQ, all recovering. Okay, risk-on rally, I'm looking for possibly energy prices to show some resiliency, some commodities, materials to show some resiliency. If you look at what's happening with the Inflation Reduction Act, clever name for something that doesn't even apply to inflation. But there will be, in a way, it's kind of like a masked climate change, build back better bill with, 100 and some thousand new IRS agents that are coming for small businesses, most likely. But Bitcoin would be my risk asset, right? Equities up, Bitcoin up, blockchain, and Web 3.0. But to get a sustained run in equities and a sustained run in Bitcoin and other risk assets, I do think the dollar has to drop. Technically speaking, this is where I'm at. I think the dollar is in a great place that is completely overextended on multiple time frames. I'm looking for dollar weakness. Okay? So a lot of this has to do with the Fed. And I know that ignores a lot of things, right? I know that China, Taiwan could be a problem. I know that the U.S. is probably kicking that hornet's nest a little bit. I know that Russia, Ukraine's not going away and the energy crisis continues in Europe. I know that, right? But the market doesn't pay attention to all that stuff. The market gets a major theme, and that's all it focuses on. And I think this year the theme is the uncertainty around the Fed. And so if there is more of a certainty around the Fed, then I think we have a reason for the market to say, okay, blinders on. We know where the Fed's going to be. Let's go. And there's money on the sideline that's looking to go to work. The Bank of America Fund Manager Survey, some of the biggest cash levels with the least amount of allocation since 2001. So if that cash is ready to be allocated and put back to work, where's it going to go? Well, if inflation's at 8%, you're looking for any type of yield that's going to match that or exceed it. You're not going to get that parking it in a bank, in a savings account. You're not going to get that parking it in bonds. As yields go up, bond prices go down. So, well, again, if the yields are capping, if the 10-year Treasury note's capping at 3.25, 3.5, that's still going to lose to inflation by 4 to 5%. So anyway, equities is probably the place to be, right? And unfortunately, it's been that way. So back to that household stock warning. I feel like 2020 would have taught people to buy and hold through the dip and not necessarily panic sell, but we'll find out. So there's lots of stuff that's happening, right? I'll focus on some charts. We'll see where, see where things go today. Couple of stocks that I'm really interested in watching till the close today. FCX. I did take an assignment on FCX. Looks like it's down a little bit from yesterday. I don't have any pre-market. This will open in 10 minutes. I'm trying to get this one called away at 32.50. I'll go back and repair it again next week if I can. Alcoa is trading at 52.60. I've got a $51 covered call out to next Friday. Hopefully that will hang on there. Get that called away for about $11 a share. Google. 118. I'm not sure what happened to my price feed. Oh, hang on a second. So let's go Google. Let me check that out. There we go. So let's just go to Google. We're trading at 118. I've got a 120. I think I have a 125 covered call. I'll check that today. It's not going to get called away. Oh, there it is right there on the charts. 130 covered call by next Friday. So I'm not intending to lose my stock since Google did that 20-for-1 split. I now have like 500 shares of Google, which I'm super happy about. So now I can use a lot more options. I can lower my cost basis, which I'm trying to do. So if it doesn't get called away, which I don't want it to, it lowers my break-even cost to 121.71. So I'm going to continue to do what I can to lower my cost on Google, chip away maybe 30, 50 cents every couple of weeks. And, eventually just if I can get my cost basis down in Google down to 110, 107, this is a forever stock. Apple's a forever stock. I have a covered call on Apple at 170 out to next Friday. I rolled that this week and grabbed another $1.33. So lower my costs on Apple, and I don't want it to get called away. I'm just using options to lower my cost basis overall. GDRX. This is trading at $7.60. I put in a $10 call out to next week. I'm going to keep an eye on this one to continue to repair it. Maybe out to September, I'll do a 750 covered call if I can get my break even below that. What else? HIMS is another one that maybe I'll lose this week. It's trading at 709. I've got a $6 covered call for next Friday. That will get called away for about 25 cents. Alibaba. This one is at 94.75. I've got it covered to $100. I'm going to try to get that one called away. Keep lowering my cost basis there as well. Halliburton. I have a $30 covered call out to next Friday. We're trading at $29.45 pre-market, so I'll keep chipping away at this one, 30, 40 cents a week. And Uber, I am going to lose the stock this week in a good way. My break even is $27.80. I have a covered call that I was trying to roll it since the stock price was $3 or $4 higher. The $29 call is where it's going to get called away for $1.20 a share. But I've got about 2,600 shares in one account and a couple hundred in another account. So if it gets called away at $1.20 a share, I'll make some profit on it. It's also a nice little repair in case Uber does dip. I would be really interested in starting some more trading. If we come back into this level around, let's say $29, I'm interested in buying. And if it pulls back even more, maybe using a simple credit spread to own it if we come back and fill this gap or come back into these lows. All right. So I don't necessarily think that the bottom is in. If you're wondering, like, is the bottom in? I think that we have pullbacks coming. So let's go to the S&P really quickly. That's SPX. That should be, that's weird. S&P 500. There we go. So 4207. I do think that dips are likely, right? We took out this recent high. We certainly could have a pullback in here. This does bring me back to the days of 1970, which I wasn't around trading at that point. But as far as looking at history, a higher low could certainly be in the cards here. We have a low from June, July. We have a low from July here. If we have a higher low from the month of August, we will see if this will continue to rip through. Maybe this is a little pullback from August, September, and then we have a nice little Q4 rip to the upside. And if you were with me last week, I think last week Friday and this week Monday, we talked about these scenarios where Q4, may get us back up to these highs with a bit of that FOMO move, right? Or we have this market fighting back here, and there's a lot of indecision, but we could be finishing here at Q4, which is, the low of the year, we finish about halfway. So the damage has been reduced. We might come all the way back down here to threaten these lows or take out these lows, but I think that's a buying opportunity for a Q4, Q1 recovery. So I do think that there is some resiliency built in. I know that we're at some trend line resistance here on a lot of these indices. You know, the S&P 500, if this resistance is going to be hit, makes sense technically that, you know, the bears might continue to channel this. But I think right now I'll be looking at higher lows. All right, I'm looking at higher lows. All right, a couple more stocks, and then feel free to type in some charts if you want to see some Forex pairs, look at some requests. Airbnb, this one, it's pre-market 123.23. I have a naked call, a 130 sell at its next Friday's expiration. I'll probably protect that today. Depends on where it has profit-wise. But I can also let it expire next week for full profit, and then I have it covered, the shares that I own, covered out to 135 with a break even at 132.74. That really all I'm trying to do is lower my cost basis more. So I will see where that one is decayed down to. If I can close that for a small debit, I might issue a new credit spread or a new covered call to again lower my cost by a couple of bucks and just stay in Airbnb. I like that stock overall. BGFV was from my two services. I've got a Pulver Report newsletter and a hedge fund alert service. And I took a BGFV trade this week that I like, and it looks like if it stays where it is today, that's good. If it stays where it is going into next week, that'll be a nice little 52-cent profit, or potentially the traders that took it with me live in class for equities on demand probably have something like 75 to 80 cents of profit as long as price stays up above 1250 by next week. So those are the stocks that I'm watching for today's close. If I lose some of those stocks for profit, that is awesome. That would be something to the effect of FCX would be a couple of dollars. Alcoa would be a big win of like $11 a share. Google, I'm not intending to get rid of. I'd roll it forever. Same thing with Apple. GoodRx, if I can lose that for a couple dollars a share. HIM will be a like 25-cent win, just trying to repair that stock. Alibaba will be like 10 bucks a share. Halliburton will be $3 or $4 a share. Uber is going to be $1.20 a share, $1.22. Airbnb. I did take a long call on Airbnb and close that for about 100% profit. It was a 480 debit, and I closed it for 975 credit. So nearly 100% on that long call, but I'm keeping that naked call in just to kind of lower the cost basis of that entire transaction and take a few more bucks on the profit side. And then BGFE, if I get this one called away, that'll be anywhere. For me, it'd be like 52 cents. For traders that took it with me, they had a better fill and a better buy level, and so they'd be like 75 to 80 cents profit going into next week. So that's what I'll be watching. Are there pockets on the SPY, Peter? Yep, great question, and there sure are. Those gaps can also serve as pockets. So as we started trading this week, and if you traded through Wednesday, right? If you were with me in live sessions, or you traded through Wednesday and saw the big CPI news move the market, this gap right here, I would expect to be filled. Okay, so I do think that coming up into that trend line resistance and channel resistance, we could be working our way back down just a little bit. We also have a weekly pivot from last week, and we have a monthly pivot for the month of August. So could we have this nice little rally to the upside and then have a pullback? Sure. Could we have a trend line that supports this out here? Sure. Could this also be a higher low? Yes. So a pullback is fine. It would be a nice little wave cycle. This could also be setting up a pattern. This level, this is a left tip, center tip. This could be a bullish crown that sets up a C to D. And again, from the technical side, perhaps we do see the markets continuing to rally through this year. I still think that Q4, again, pending that we don't have a regressive Fed, right? If the markets are gonna take in all this pessimism once again, or the Fed is going to increase their rate projection by the end of the year, that is what can take all of this away, right? So right now I'm cautiously bullish. I'm looking to buy dips to go back up and reach higher highs through the rest of the year. But if the Fed narrative changes, if the Fed data point changes, if the Fed inflation stance changes, and they adjust their policy to exceed what the market expects right now, guess what? This dip, or I'm sorry, if this starts to fall, this could pick up a lot more momentum to the downside and just stay in a bear channel. But I think in the absence of a top in the yield expectation with the bottom in equities, a peak in inflation with the bottom in equities, I think there's enough fuel behind this because all that pessimism and uncertainty has been projected in and priced into the market. So if we see that it's stable and there's no big surprises, then I think that the market continues to find ways to rally, and I'm buying those dips. But traders know this that are trading with me in equities on demand. A lot of credit spreads, okay, dipping my toes in a lot of places, good variety, good diversification, because I don't know where the winners are going to be. Is the winner going to be in tech? Are we just going to have a simple, like, just buy Microsoft, buy Google, buy Apple? That's it? Like, that's the best way to make money this year? Probably not. You know, we've had some major discounts in tech. I think there's recoveries. We looked at ARK this week, ARKK, right? The classic ETF that was up, thousands of percent, that lost 70+% of its value. It's up 77% from the lows. But when you have a 70+% decline, you need a 230+% rally to get back to the highs. So it's still not even a third of the way there to those recoveries. So tech can recover, and I'm glad there's going to be plenty of short-term opportunities, but I don't think tech is a full-on positioning. Okay. So anyway, that's where we're at. I see some questions there. Pound yen, pockets on the SPY. So yes, Peter, to answer your question, yes, pockets on the SPY, look at gaps. So the way I see this right here on the SPY, there's a nice little pocket trade back in this area, right around 430. So they'd be around 4,300 on the S&P 500. But because of the price gaps we had this week, that'd also be a pocket right here that's going to be a magnet. And because we've had a nice little rally to the upside, I would like to see if price can pull back a little bit. If we can pull back into this pocket, even pull back into this pivot, I think it gives us a chance to buy a dip, buy some confirmation, and then take this back up into higher highs and fill this pocket and see if the market wants to come after this resistance and score some point for those bulls to the upside. So right now I'm more interested in buying dips and looking at, I'm trying to be cautiously optimistic but bullish going into the remainder of the year. The second half of the year I think is going to be way better than the first half, right? Because the market took all this stuff in stride and all this stuff pretty much on the nose. And now that we have a little bit more certainty on inflation, a little bit more certainty where the Fed is at, I think that helps the markets price in the 6 to 8 month forward guidance, which it typically does. Okay, you should be able to, Peter, if you have the indicator on Smart Trader, you should be able to put that pockets indicator on it. Yep, if you have the stock feed. Let's go pound yen, New Zealand yen. Pound yen, those are requests. So pound yen, I'm still looking to short it, but I'm interested in shorting the pound yen off of this resistance here. So this, no joke, this is actually looking like a fantastic rising wedge right here. Okay, so let me draw this out so I just use a straight line the entire time. So we have resistance here, which certainly could be horizontal, okay? But you connect these lows, and how good does that look? So what I would like to see happen, again, if I'm going to wait for an entry, I wouldn't mind looking at a small entry here to sell and a small entry here to sell. So position 1, position 2, try to short the pound yen and get a head start back down to this support. If it breaks this low, this is open space to fall all the way back down to where this thing started. So the pound yen, to me, could be a massive short opportunity if we have a chance to short it higher. Now, right now, it's a bit messy. You see, the last couple of weeks have been really choppy. We might have some indecision here. If this indecision picks up to the downside, if it's open space, then we can short the pound yen. But if it pulls back up, and stays within the structure, I think we can sell this nice and high around 167 to 168. Okay, so that's pound yen. Let's go to New Zealand yen. New Zealand yen is in a similar boat. So this actually is setting up for a pretty good sell opportunity going into the next week or so. I think coming into this week's close or early next week, let's look at this, and we'll take a look at this Monday for the YouTube session, also in Flex on Tuesday. But look, Flex traders should be in these Mondays and Friday sessions. That's how I kick off the week. So we've talked about looking to short this thing around 8650 to 8700. I will probably do that. I'll probably look to short this in here and try to take it right back down. Again, you can connect the lows. Okay, if we short it nice and high, if we fall back down to this area, great. If it wants to break eventually, that's fine. But if we short it high, we have a chance to take some profit in here or protect our profit, eliminate risk, use a stop loss. And if it breaks and goes lower, then down it goes. But I want to sell the New Zealand yen nice and high. Okay, dollar yen. Dollar yen, I still like this move back down to the 200 EMA. We've broken below the 50. I told traders this week we might have a low to high, higher low to higher high. We might have a little channel in here. that we have to adjust to. So a high to low swing, see if we have a little bit of a pullback, and then a drop. This might also be, I mean, if this is actually a decent swing, there could be a little Gartley pattern against this, which means we have high to low, and then we have a 1, 2, 3 wave move to the upside. Okay, or it's an A, B, C, D to the upside, and then we proceed to go with that larger swing to the downside. So I'm still looking at this, and I'll use a larger line. So I'm looking at this swing to be matched over here. But to do that, we might have a subswing inside that's a little, ABCD move. But I'm still looking for the dollar yen to find this 200 EMA, find this low. We've already projected this potentially down into like 116 and 115. But I don't think I'm going to hold it that long. I mean, the position I have on dollar yen, I'm happy to take profit over at this low back around 126 or so and look at that daily 200 EMA. Okay. Michael says, when I see pockets on multiple time frames, I get confused. Well, okay, then simplify it. What time frame do you think is more important? I mean, so I'll say this. If I have a pocket, let me just use an example. If I have a pocket right here on a daily time frame, okay, and let's say that the market is pushing bearish and we have this really large candle and the price has been falling lower. At some point, to me, I'm a bigger believer that if this is a higher time frame, this market's going to find a way to go back up and fill that pocket. Okay? So if you're saying you see pockets on opposite directions in different time frames, I tend to side with the larger time frame. Because to me, it should be, if this is a move that creates a pocket and goes lower, 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 look, I don't really care about like, oh, we created an upward move in its little pocket, I want to short that. I'll probably go with the higher time frames pocket because that's my bigger alignment, and to me, it's the higher time frames that typically have more weight. If I'm looking at analysis, I'm looking at big levels. If I can get a higher time frame to show oversold conditions and show divergence, I'm going to start to buy that. And if I see a pocket that tells me to sell it, I'm probably going to ignore that pocket. Instead, what I'll do is I'll use, if this is my price target, let me go back here a little bit. If this is my price target, what I will do is, let's say we create a pocket that tells me to sell it. Well, rather than selling that, I'll just use the pocket to buy and look at more support. If there's another pocket telling me to sell it, I'll use that as a support level to buy it again, and I'll target the higher time frames pocket. So that's what I like to do. I'll typically go to the higher time frame and side with that one. There's a little bit more clout on that higher time frame for me. So hopefully that helps. Right? Any other charts? So FCX, Alcoa, Google, GDRX. I'll review the portfolio A to Z. We had some alerts going off this week. Pinterest sitting at 23 and change. ARKK, as I mentioned before, had a nice little rally. We pulled back, so we had highs around 54. I don't think, did I put in? I'll have to check. I might have canceled that pending order. I did like a 54 by 55 bear call spread. I'm going to check and see if that got filled. I think I canceled that trade. Apple is, as long as we're staying below 170, we're at 169.69, and I will keep moving that up. I do not intend to lose the stock of Apple, even though my ownership price is like 140. I guess I don't mind losing it if it was, $30 a share. That's pretty good, since I'm in a decent chunk of shares. But I also don't want to lose it if I don't have to. I'd like to own Apple forever if I can. Anything else? I did take some losses this week in stocks. I closed out some really crappy positions. One of my important, lectures and recommendations for traders has been, again, for educational purposes only, has been, if you have dead capital, get rid of it. So I took losses on stocks that have been underperforming like crazy, have not helped me at all, and they're just tying up my cash and my margin. So I took a loss on Arrival, ARVL, a loss on BFI BurgerFi, BODY, which is Beachbody, Catapult, Car Lots, OpFi, PaySafe. A lot of those were SPAC plays, those special purpose acquisition groups, which, karma wise, I kind of consider it a whole wash, because in 2020 and 2021, I traded SPAC, and they had these big pops, and there were, lots of profits to be made. And I did make a lot of profit on those. But taking a few positions and holding them and watching them go against me 70%, 80%, it's not worth holding. So I dumped a lot of those positions for losses, but I did get my cash back. I have my margin back. I'm not tying up all that capital. And now I have way more free capital and working capital, as opposed to dead capital that's doing me no good. Okay? All right. So anyway, did take some losses this week, but that's fine. Lowered some costs on covered calls, getting a couple of stocks hopefully called away today and next week. And it's been a busy week. We had a good trade running on USO. We took some credit spreads on USO to follow oil, 74 by 73 US oil. Down to 92, but we're going to see how this plays out. I think oil off of this low and this high, if we're going to bounce here, I could see oil finding a channel in here. Okay, now having said that, if oil makes a bit of a crash to the downside, and the timing of this will be really interesting coming out of summer, because once school starts again in September, once the vacation period is over, once travel demand starts to go down, we may not see sustained oil prices at the current levels. So if oil does in fact dip below, let's say $85, for the near term, we might be putting in a pretty solid top in energy prices, right? Which again is kind of surprising considering we have a, Russia versus Ukraine still ongoing battle, conflict, and it's affecting Eastern Europe. It's affecting energy prices. It's affecting the friction. It's creating friction in the global economy where now everyone is trying to do their own stuff. Europe is trying to be more energy dependent or energy independent rather. And listen to an interesting podcast this week in Search of Green Marbles with Weiss Capital Management CIO, and I think he's got a higher title than that. But Jordy Visser was on this week's podcast. Anyway, he was talking about this reaction or Eurozone's reaction to the Russia-Ukraine crisis is to align and look at nuclear as an alternative, to look at different energy sources to get off of the dependence on Russian oil. And, again, I'm not saying that what's happening with Russia-Ukraine is similar to what happened with COVID, but the collaboration and the solutions that are trying to be reached in a short amount of time is a lot better than just hoping and praying that everything works out with Russia Ukraine. So in a way, it's almost like the necessity is it is creating actions to get off of oil dependencies. So energy has been super volatile this year. We know that it's created a lot of profit opportunities. It's created really interesting narratives, and I just think it's one thing you've got to trade. I see a lot of traders out there like they're all in on energy, and I've got traders that are talking about $200 oil and $300 oil. I don't know. I mean, I think it's great to have that in your head, but I would only be allocating maybe 10% of my portfolio to that, maybe 5% because it's going to be super volatile. So I really think, I'm taking the Ray Dalio all-weather approach. I want to be diversified. I want, correlations and negative correlations. So even if the market is going to go up, I've got some winners. If the market's going to go down, I can manage my risk, right? I think that's the best way to be trading right now. I don't want to have a lot of fluctuations. I don't want to be tied to one thing where the whole market goes up or down. That's how I win or lose. I want it to be kind of negatively correlated if possible, right? So anyway, alternative energy. Yeah, I mean, what about it? We have it, right? We have all the technology. The problem is it's just not implemented. And again, I mean, the U.S. is a poster child for potential alternative energy sources because our economy is 70% consumer. So guess what? If our consumer wants alternative energy and we demand alternative energy, guess what we're going to get? Alternative energy. But if right now we want cheap energy, we're not going to get alternative energy because you can't have alternative energy that's cheap because it's not mass produced and not everybody has it. So this could be a multi-year transition. This could take 3 years, 5 years, 10 years to have all this stuff play out with what's next. Does every house have solar panels? Does every house have, geothermal? Does every house have something different? Maybe, but it's like it just doesn't happen overnight. And so that's what makes, energy so volatile right now and so uncertain. I've seen oil prices projected to be $50. I've seen it projected to be $250. Who's right? Doesn't matter. If you're trading and investing in energy, you got to be prepared for it to go to $50. How does that affect your position? Or if it goes to $250, how does that affect your position? Right? It's just about risk management and how you're positioned in your portfolio. Okay? And as far as new startups, I mean, yeah, that's exciting, but how much cash do they have? New startups are just like anything else. I mean, look at the electric vehicle, and I mean, you look at Ride and Workhorse. I mean, those are like highly shorted stocks at 25-30% short interest float. If they have cash to survive, they'll be okay. But startups, if you run out of cash right now in an increasing interest rate environment, it's hard to borrow. It's expensive to borrow. So startups are probably going to be difficult to manage and survive right now. But again, what do I know? I'm just a trader. Let's see. Explain your friend that uses a 4-hour by 1 hour trading strategy. Not sure who that is, Michael. There's lots of friends that have 4-hour and 1 hour trading strategies. I don't know. I mean, if you were watching the trading battle last night, I know Dave Floyd was talking about a 4-hour structure off of higher time frames. I've seen friends. Yeah, the guy that taught me traded 4-hour, 1 hour, all the way down to 1 minute charts. That's something I've talked about for years. So I'm not sure like who you're talking about. I've got a friend that uses weekly and daily charts and trades 5-minute charts. So look, there's no secret, man. I mean, honestly, like if you're looking for a specific secret, it doesn't exist. Just freaking trade price action and keep trading. Use good equity management. Don't do anything stupid. Don't settle for mediocre setups and keep trading. Everybody asks me like, what time frame do you like to get into the market on? I don't really care because what I'm doing is I'm building a position based on daily analysis, weekly analysis, bigger time frames. So for me, I could trade a 1-minute chart, but I don't care about precision a lot of times. A lot of my trades are investing trades. So I will build positions to take profits at my bigger profit levels. Very rarely am I looking for intraday movements, because I think a lot of it's just noise. The market has created tons and tons of noise. Here's one quote that I can leave you with for today as we wrap up the session. It's been a long session, by the way. Sorry for the audio visual stuff this morning. But Jesse Livermore, here's the quote. The stock market is never obvious. It is designed to fool most of the people most of the time. Take that for what it is. All markets do that, right? You think you have the perfect entry and the most precise entry in that smaller time frame? See how many times that happens out of 100 trades. I doubt anybody as a trader, real traders too, professional traders, I doubt anybody, you give them 100 trades on a 1-minute chart that they're going to have all winners. You can't pick trades that well all the time. So to me, it's not about precision, right? My days of trying to be perfect on every entry doesn't matter. I'm trying to be right in the general direction and catch where the momentum is going. So what do? I look at major levels of structure, highs and lows, overbought, oversold conditions, buy low at support, sell high at resistance, and grind. Doesn't matter what time frame, just trade. All right. Don, MARA, then we'll wrap up. That'll be the last one. MARA is the North American miner. They left China. They left Kazakhstan. They went to the U.S. So MARA, Marathon Digital. They're trading at 1721. Holy shnikes, this thing is on the move. I do have a $20 covered call, which is good. I doubt it's going to get called away. But the good thing is next week, that should be worth even more to lower my cost basis and hopefully get this thing. I don't necessarily want to lose the stock at $20 if I don't have to. I also have a $21 covered call as well, so neither one of these are probably going to get taken away this week. But because the price keeps going up, that's a good thing because those premiums will increase, and I can just go week to week, chip away at my cost. But a lot of this is correlated with where Bitcoin is going. So surprisingly, MARA has made a really nice run to the upside, and Bitcoin is still kind of in this structure here. Let me use a straight line. So Bitcoin off of this low, I'm just a little cautious of this current environment. We had this really big flush down bear flag. I could see Bitcoin coming back to this support. I could see Bitcoin coming back to this breakout point. I could see Bitcoin choppily working its way up into this 200 EMA. My concern is that once we get here, if we don't break and go higher, we're going to break and go lower and revisit the lows again. And I could see, Bitcoin having this flush, correction, flush, correction, flush, correction. We have a range that's going to establish. We have highs around 30K, lows around 20K. And maybe for the next 6 to 12 months, Bitcoin is in a $10,000 range. 20K support, 30K resistance. At some point, you pay attention to it, we break above 30, it's open space to the upside. But I just don't like the current behavior of Bitcoin because we're not showing a lot of control by the bulls. We're showing there's a lack of selling, which is a good thing. But considering the stock market's been up, on a pretty steep incline, and Bitcoin has not been, I just don't know if there's just been too much damage right now in the crypto world, where it's just equities is a bit of a safer play for risk assets versus crypto for now. But anyway, that's that. But to Don's point, MARA has had a great little recovery. We have some shares on that one. We have some credit spreads on that one. Also, RIOT, another miner. This one's been up as well. We have a 6x5, and that credit spread's working out for a nice little chunk of profit by the end of the year. So, all right, everybody, I'll let you go. This session flew by. I've got class at the top of the hour for equities on demand. Markets are up a little bit, which is not bad. So we'll see where they close on the day. A little bit of a gap higher from yesterday. We have gaps in here from Wednesday CPI data. I'm interested to see if next week by Friday, with that big monthly expiration, if the S&P is back down to fill that gap. I'm going to put a little box in here. So this gap right there, if that is filled going into next week. Okay, so that pocket I can get rid of. This pocket I can get rid of. Trace that pocket right there to see if we have a pullback coming next week. All right. One quick thing is everyone's tuning in and we're wrapping things up. If you would kindly hit that thumbs up button for me to like and subscribe, subscribe if you want to. Obviously, we're live on Mondays and Fridays. Get the notifications. Check out the other videos I have in the channel. But it helps the algorithm. It supports the channel a ton just by watching live, tuning in, engaging, typing in some comments, and hitting that thumbs up button for me. It helps me a lot. Okay. So thanks, everybody. Have a great weekend. I'm just typing this in. And we'll be back here on Monday, same time, same place, for the Pulver Report, 9 a.m., youtube.com/Chris Pulver. Cool beans? All right, we got it. Cool beans from Michael. All right, cool, everybody. Thanks. Equities on Demand students, I'll see you at the top of the hour, 10 o'clock, and we'll wrap things up for the week. All right, take care, everybody. See you next week on Monday. Bye.